So how do you become competitive in today's market when there are so many multiple offers and you've got a home to sell? Can you buy your next home without having sold your own home? And there's a number of issues that we need to talk about here. That is, oftentimes your down payment on the new house is currently wrapped up in your old house. You are relying on the sale of your house in order to use the down payment on the new one. Or there are times when you don't qualify with true mortgage payments and your plan is to rent out your current house so that we don't have to count that old mortgage payment against you in order to qualify. Those are the kinds of things that can make you a competitive buyer, and that's what we're going to talk about in today's video. Hey, I'm Peter Lindquist. I've been a mortgage lender for over 30 years in Minnesota, and I want to share some of that experience with you today. Let's start with the first and most obvious thing, and that is you've got your home sold, you're closing soon, you got a bunch of money from that, and you're going to put it as a down payment on the new home. And that can work sometimes. It's not very common in today's market where it's a very fast-paced market. And oftentimes there are multiple offers on a property. So you don't have an opportunity to make an offer that is subject to the sale of your home. In days gone by, that was a common strategy. I'm going to buy your house, but first I've got to sell mine. And so once I sell mine, I'm buying yours. That's just not common when there's 10 offers on a property. A seller has the opportunity to choose from whatever they want to buy. So people have been looking into, how do I buy the new home without having sold your old home? That's what we're talking about. There's two big issues here. One is sometimes you need the money from the old house in order to go, to buy the new home. And sometimes you have a hard time qualifying with the old house payment and the new house payment. Let's start with the most obvious case first, and that is you've got down payment money. You've got 70 grand in your bank account and you're trying to buy a $500,000 home. And so now you want to go buy that new home. And so the obvious answer there is you've got the money, go ahead and put it down. Now you need to qualify with both the new house payment and the old house payment. And when we talk about the old house payment, we're talking about principal and interest, taxes, insurance, and homeowners association dues. So it's that full package that we've got to qualify you with when you go buy the new home. So that's scenario number one. That happens sometimes, but you need to have significant amount of money in the bank. The next one is, how do we get money out of your current home without selling it and then go buy the new home with that money? So now we're talking about something called a bridge loan. And with that type of financing, it's basically a second mortgage on your current home that is secured by the equity in that home. And now you're getting that money in order to use as the down payment on the new one. The challenge there is that now you need to qualify not only for your new house and your old house payment, but you also have to qualify for the bridge loan. And bridge loan financing is very different from the type of mortgage you're getting to buy the new home. It's short-term financing that's offered by a few banks and credit unions. So bridge financing is typically best for buyers that have been in their homes for quite a while. They've got a significant amount of equity, and now you're borrowing against that to buy the new one, and you're qualifying for 3 loans. The idea with that type of financing, of course, is short term. That's bridge financing in which we are using real estate to get your down payment on the new house. There's other ways to get down payment also. And while it's traditionally not called bridge financing, it is really one of the most common things that we do. So let's assume for the moment that you've got $70,000 of equity in your old home and you want that money to buy the new home. One of the most common ways to deal with this is if you have a substantial 401k at work. Let's say you've got a 401k that has anything over 100,000 in it. Now, 401ks, almost all of them, offer a way for you to borrow against it without any tax implications or penalties. So you've borrowed against your own funds that are in the 401k. This only works with 401ks that are through your current employer. If you've got an old one, you would need to roll it over to your current employer in order for you to have access to be able to use this. 401k loans will typically go up to 50% of what's in the 401k, not to exceed $50,000. So if you've got over $100,000 in it and you have no other loans against the 401k, quite commonly you can get $50,000 out of it. The nice thing there is there's typically no closing costs, and any interest that you're paying back to yourself. And that's because it's a cash asset that you're borrowing against. I want to make the caveat that you would want to talk to your financial advisor, of course, before you do anything like that. I'm not a financial advisor. I just know this is common for what people will do. If you have other assets, you can also borrow against those. You've got paid off cars and they're worth combined $70,000 and you need $50,000 to go buy the new home. You can borrow against those with a new loan to go buy the new home. Now keep in mind, the intent here is short-term financing. So whether it's 401k or car loans and you've borrowed this money, once you've sold and closed on your old home, whether it's a day later or 2 months later, you're taking the money from that and then paying off whatever debt you've accrued in order to bridge that gap. That's the way it can work for buyers who feel trapped in their current home because they need the money in order to go buy the new one. But now let's look at another circumstance, and that is a buyer who has this great low interest rate of 2 or 3%. They don't want to give it up, but they also need a new home. One thing that more and more people are doing is they are renting out your current home in order to buy the new one. Now, for some buyers, that's just a choice. For other buyers, you need that in order to qualify. So if your new house payment is going to be $4,000 a month and your old house payment is $2,000 a month, that can add up pretty quick and you might not end up qualifying with all of that debt. So then the way to handle that is, if you're going to rent out the old house anyways, is to secure a lease on the house that you are departing from. And the way we treat that income on that lease is that we're going to take 75% of whatever that lease is and we're going to apply it against that payment. So let's take the example that your mortgage payment is $1,800 a month and you've rented it out for $2,000 a month. We are going to be able, in most cases, we can take 75% of that $2,000, and that works out to $1,500. We're going to use that to offset the $1,800 payment, leaving you with $300. So we still have to count some of that payment against you in your debt to income ratios if that was the numbers that we're using to calculate. If you get a much larger rental, it's $4,000 a month and your payment is $1,800. Now 75% of that $4,000 is $3,000 a month and your old house is $1,800, so you've got $1,200 a month there as potential income. And that's great for you, but you might not be able to use that income to qualify. In fact, you can't unless you have an experience as a landlord. And we would have to document that you've had experience as a landlord for at least 12 months. That money has to go into your account prior to closing in order for us to consider using that to offset your current payment. Now, if you don't need to but if you qualify with the old payment, we don't even have to worry about it. We're not looking for any documentation. But if we need to qualify you with the new rental income to offset your mortgage payment, now it's a little bit of a timing issue, because now you need to get your house rented, get the deposit check and the first month's rent and a lease, and you need that to get us to underwriting, typically not later than a week before closing on the new house, in order for this to all work and for you to qualify to buy the new house. With conventional financing, that's the way that you can buy a new house without having sold your current one. The benefit, of course, is that you can make an offer that is not contingent upon the sale of your home. If you can qualify for owning two homes at the same time, now you make the offer non-contingent upon the sale of your home. You become a much stronger buyer and are considered to be a competitive buyer